We're in the midst of a very long bull market cycle, one of the longest in U.S. history, and we have not violated any bullish trends since 2009. It's been a very, very long secular bull cycle. Normally, kind of these full market cycles, they can last around 20 years. We're at the longer end of one of these, what we call a secular cycle. Now, secular cycles are important to understand. Going back to 1900, you have secular bull markets and you have secular bear markets. A secular market is when the price of the market trends in a direction over time. So if it's trending higher over a period of time, that's a secular bull market. If it's stagnating or declining over a long period of time, that's a secular bear market. And if you go back and look historically at markets, we cycle from one cycle to the other over time. And so you had from 1871 to 1901, you were in a secular bull market. From 1901 to basically about 1920, you were in a secular bear market. Then it was a bull, then it was a bear. Bull, bear, bull, bear, bull, bear. Well, now we're in a bull. And this all is a function of valuations over time. So when valuations are fairly cheap, that's typically where you end secular bear market periods and a bull market starts. And when valuations get very elevated, that's typically when bull markets end and bear markets begin. But again, this has been a very, very long secular bull market that we've been in. But what's important to note is that purple dashed line is that full market cycles encompass both. Because again, for every bull market, there has to be eventually a bear market. Bull markets don't last forever. Eventually, you're going to have a reset of some sort that corrects valuations. We go through a period of time where markets reset themselves. And this is regardless of Fed intervention or anything else. It's just how markets work. When you go through one of these resets can last for quite a long period of time. And again, that doesn't necessarily mean that prices only go down. If you take a look 2000 to 2015, markets went nowhere. It just means that they just kind of go sideways. This is why we talk about periods of no return. Look at 2000 through 2013 as an example. Your return was zero. A lot of volatility in between. Had some bull markets, had some bear markets on a cyclical basis. But again, your net return over 13 years was zero when you got to that point. So that's what a secular bull market is. Just very, very low rates of return. It doesn't have to be negative. You got to have a 2% rate of return over 20 years. So the point is that when you're in the middle of these secular bull market periods like we are today, it's easy to forget that the market has a full cycle to it. And that eventually you'll go through one of these periods where markets will just gyrate sideways for a while. And there's going to be some big drawdowns, there'll be some rallies, there'll be some drawdowns, some rallies, drawdowns, some rallies. And at the end of 10 or 15 years, you go look back and go, wow, I made no money. We're not there yet, but that is what is on the other side of this very long period of exceptional returns that investors have experienced over the last 15 years. It's been a great market. It's been easy.
Catch me daily on The Real Investment Show. The link is in the description.